There was a time when sustainable investing tended to be associated with negatives. That could be in terms of avoiding negative externalities by excluding certain stocks or sectors, or the common misconception that ESG integration would somehow reduce investment returns. Thankfully, the picture has drastically changed in recent years, and the focus of today's discussion will be very much on the positives. We're going to be looking at the why and the how of transition investing. It should also be highly relevant to asset owners that have committed to a net zero target. There's a growing consensus that the only way to resolve the climate crisis is a radical rewiring of the global economy, away from fossil fuels and unsustainable linear value chains. We will be looking at the best way for investors to successfully navigate this low carbon transition, both in terms of managing the associated risks and identifying the vast number of new opportunities that it brings to the markets. It's very much about sustainability being less of an obligation and more of an opportunity. How can investors make sure they will end up on the right side of the transition equation? So to answer that question, we've brought together a panel of experts from Switzerland, London, and Stockholm. The first of which is Charlotte Månsson of BlackRock. She is head of sustainability for the Nordic region. Charlotte's worked in sustainable investing for about 20 years so far, most recently as senior vice president at Sustainalytics before she joined BlackRock earlier this year. She's a director in BlackRock's Sustainable and Transition Solutions team, focusing on client strategies, product innovation, data analytics and solutions. So welcome, Charlotte. Perhaps to set the scene, Charlotte, would you be able to talk us through just a picture of what the transition consists of and what's driving it? What are the forces at play?
Thank you very much, Richard. And thank you for having me here today. Yes, I think it's important to set the scene for the transition. The topic we hear most from clients around the world at the moment really is how to understand, navigate, and participate in the transition to a low carbon economy. So our work in climate and in transition is really rooted in our fiduciary duty as an asset manager to help our clients improve their long-term investment outcomes. And as such, as a fiduciary to our clients, we work with them to understand, navigate, and drive if they choose this transition. We believe as a firm that climate risk is investment risk. We believe it will impact returns in investors' portfolios as companies navigate both the physical risk and the transition risk associated with climate change. As such, the transition presents extraordinary investment risks, but it also presents extraordinary investment opportunities, as it will require massive investments and it will create millions of jobs. So according to the International Energy Agency, reaching net zero by 2050 will require 125 trillion US dollars investments in low carbon technology and infrastructure. And that's over 4 trillion US dollars every year compared to the current 1 trillion, which is being invested. So a quarter of this, so around 32 trillion US dollars will be needed by 2030. So these are massive numbers. These are significant investment flows that will be required. So we believe that the transition will be an economic transformation really on par with digitalization, emerging markets. And so, for example, the energy and power sector will need a scaling up, a 10 to 15 times scaling up of zero carbon energy generation by 2050. It's going to require grids that can store and actively manage variable energy sources and intermittent energy sources as well. So we need energy that is sustainable, affordable, and secure. And currently we don't have any that fits all those three requirements. So an orderly transition that reaches net zero by 2050 will benefit the economy. It'll spur job creation, and we believe it can create up to 30 million new jobs in clean energy and innovative technologies by 2030 as well.
We're now aware of the scale of the thing, but what's actually driving this? Is it regulatory change? Is it market forces? What exactly is behind it?
Yeah, so the transition is actually already underway, and it's really accelerating, and it's being powered by three long-term forces. One is societal preferences, other is technology, and the third is around policy. So technology costs are already going down. There has been a 85% reduction in solar costs over the past decade, for example. And societal preferences are changing. Annual sales of electric vehicles have doubled globally in 2021, and in China it has tripled. Policies gain momentum. We've seen that 83% of global emissions are covered by country net zero targets. And the US passed earlier this year the Inflation Reduction Act, which provides nearly 370 billion US dollars of tax incentives, rebates, grants, and so forth that aim to cut US annual emissions by about 40% by 2030 compared to 2005 levels. So these are some of the major forces that are driving the transition, and we believe it's going to accelerate. Markets are consistently underestimating the disruption, including that virtuous cycle across these three forces. And our view is that the transition is not fully priced into markets, and that thereby creates an investment opportunity today. So with that, the transition is already underway, and all companies and investors are having to navigate the way that economies are being rewired by taking a view on how the transition is going to shape their own operations or investments. And we have met with leading corporate CEOs and CFOs in carbon intensive industries. So these are electricity, oil and gas, automotive, industrials, and so forth. And they're all leaning into the transition. So when we are out speaking with these leaders, they are telling us that they all have strong convictions about the commercial opportunity of the transition. They are confident that their customers, their suppliers, their employees, their capital providers are going to support them, and they are supporting them in this journey as well. But there are also a lot of concerns. Capital markets have mostly focused on green companies, and they're still looking to distinguish between carbon intensive companies that have serious transition plans and those that don't. Leaders are worried about policy clarity and incentives, in particular whether there's going to be investments in or sufficient investments in enabling infrastructure. So these are, charging infrastructure for electric vehicles, pipelines, and so forth, or whether some of these infrastructure are going to be stranded. Lastly, there are concerns about governments, policymakers. Many are waiting for them to act and accelerate that shift to a low carbon economy through regulations, incentives, and investments. And I think it'll be interesting also to see what happens in the coming months after the COP27 as well. So I think decarbonization is rewiring the real economy, but it's also transforming entire sectors. And as an example, I can talk a little bit about the automotive sector, for example. These entire value chains, it runs from sourcing of raw materials to manufacturing to customer usage to end of life and so forth. And if we look at the automotive value chain, electrification is really at the forefront. We see a large growth in electric vehicles. We see a lot of them on the streets and so forth. And it's driven by that technological shift, by consumer demand and so forth. And EV penetration is projected to increase in the next decade, making up to 30% of new car sales by 2030. But it's not all smooth sailing. The main challenges to electrification include industrial speed, cost for mining and refining some of the raw materials, ecological issues related to the value chain. So, for example, lithium mining. As the transformation unfolds, we're also expecting some bottlenecks to emerge throughout the supply chains, like insufficient battery production, for example. And so I think that the shift to electric will be there will be some bumps literally in the road, but along the supply chain as well. But we see that the companies are really leaning into this transition.
So thank you, Charlotte. That's an excellent insight. What are you hearing from your asset owner clients in terms of how they're approaching this and what questions are they coming up with?
We are hearing a lot of questions from the market and from clients, such as, how will the transition unfold? What are the risks to my portfolio? What are the biggest investment opportunities? Which are the sectors that we should be focusing on? How do we identify those companies that are in transition? And how do I really measure and implement my net zero commitments? And we held a transition investing global summit earlier this summer, and we asked our audience, there was just over 1,300 clients from EMEA, APAC, and the Americas. We asked them to poll on what is the biggest challenge you face in positioning your portfolio for the transition. And the top two challenges by clients were there are multiple data sets and inconsistent disclosures. The second was there's lack of clarity on the speed and path of the transition. So there are still some really big questions there. And I think our clients' biggest challenges, they fall into three different categories, and one being execution. So they are really looking for guidance and support in executing on those commitments, including assessing starting points, transitioning assets, measuring progress, reporting, and so on. And the second is around the data and reporting. So how do you measure and report consistently? There are so many different data sets. There are new regulatory requirements, and there are, as I say, inconsistent disclosures. And so that's the second bigger category. And then the third one is really, how do you transition an entire portfolio? So that whole portfolio solution. So, they're looking for ways to customize, green the core of their broad market equity and fixed income exposures, and they really want to incorporate climate awareness into their alpha and alternative books as well. So I think many of what we're hearing, investors, they start out maybe by listed equity, and then they move into fixed income, and then they start moving into the alternative space, which presents some different challenges also because of data.
Our second expert is Fredrik Magni of MSCI. He's head of client coverage for the Netherlands and the Nordic region. Fredrik is responsible for maintaining and building MSCI's analytics, ESG research, index, and private assets business in the region. Before joining MSCI, Fredrik had a 19-year career, if I counted correctly, at Morgan Stanley, most recently as managing director and head of equities for the Nordic region. So welcome, Fredrik. If you put yourselves in the shoes of an asset owner and a Nordic pension fund or insurance company that maybe is signed up for a high-level net zero target and is looking at investing, changing their investment strategy, basically, where do they start? And what are your suggestions on that front?
So first of all, I must say I echo a lot of what Charlotte said in terms of the engagement that BlackRock is having with the Nordic clients. We recognize a lot of them. Myself and my team, we have a lot of very similar conversations with the clients. I also agree with what you said in terms of the scale of the opportunity and the scale of the transition and how it very much requires stakeholders working together. So with that in mind, we see our role as helping facilitate, helping provide data, helping provide processes, solutions for clients to go from, target setting into very much what Charlotte said at the end in terms of implementation. So with that in mind, what we have done from MSCI is publish a guide of net zero transition as a framework for people to help them think about this. And I would really like to start to say, but there is no right and wrong in terms of doing this, right? There's so many different ways, so many different approaches you can take. And I also very much agree with what was said earlier in terms of the focus on this. It is and continues to be very, very high. So the first of all, I would say, is just to understand the basics. There is a lot of new vocabulary. There's a lot of acronyms flying around, and there is new way of measuring data, new data points that many of us are not used to. So that's definitely, as far as we are concerned, point number one. The second is to look at where is your portfolio today? What's the carbon footprint, if you like, of your portfolio? What's the profile of your portfolio? And based on that, you go onto the implementation. But clearly before that, you need to set your targets. And that's what many of our clients have done. They've set net zero targets to 2050, 2040. And as you heard from Charlotte, the same is the case for most listed companies globally, or at least in EMEA, and I think it's spreading globally. So that's the first step of the process. And then it comes down to what I would say the biggest challenge is, okay, how do you go from this big target setting into implementation? So you know where your portfolio is, you know where you want to be. How do you facilitate this transition? And that's where the challenge comes. And I think that's where a lot of both corporates and investors are focusing their attention on right now. What we are hearing from especially asset owners is an increased shift towards engagement and away from the pure divestment. That was the 1.0, if you like, where you just got rid of companies in your portfolio. Yeah. And you then said, okay, this is my portfolio and it's relatively aligned with a net zero strategy. And then you make it somebody else's problem.
Yeah.
I think increasingly now investors are looking at the real world impact of their portfolio and what they're doing. And they realize that just shifting it is one way of doing it, but maybe not the perfect and maybe definitely not the complete way of doing it. So there's a large, a very strong focus on engagement. And for that, clearly you need tools and you need data and you need a framework in order to systematically engage with companies in your portfolios and potential investments that you want to make. And what we're hearing from a lot of, especially Nordic asset owners, is where they feel they have the biggest impact is in terms of greenfield, new private asset investments, where they're helping finance battery factories in the north of Sweden to help facilitate the transition into the electrical car future that Charlotte referenced. There's also a lot of Danish, also Swedish and Norwegian investors are investing heavily in wind farms, solar technology, wind farm technology. So those are very tangible examples of where there's new money put into investments in order to facilitate this change. And then it's about working with companies in terms of supporting them, of transitioning their business model from where they are today until where they need to be tomorrow. So that's very much a big focus of what we do.
Yeah.
And then it's the reporting, the regulatory reporting, the requirements from stakeholders, from regulators are ever increasing. And that's I guess both an opportunity and a challenge for our clients. So a lot of clients right now, they primarily see it as a challenge, at least initially. How can we report on all these data and all these requirements that are being put on us? So that's also an area where we work closely with clients and try to support them.
And our final expert is Dr. Oliver Marchand, who is Managing Director and Global Head of ESG Research and Models at MSCI's Climate Risk Center in Zurich. So Oliver is a pioneer and innovator in climate risk analytics, having founded the fintech company Carbon Delta in 2015, introducing a proprietary climate value at risk, or VAR, model to help investors manage climate-related risks and transition opportunities. And that company was acquired by MSCI in 2019. So welcome, Oliver.
Thanks for having me, Richard.
So it'd be fascinating to hear a little bit about your work and how that fits in with people's portfolio management, because ultimately it's the asset owners that are going to have to be using these tools.
I'll try to be brief and at the same time explain the metrics in the context of the use cases that Fredrik had mentioned, which are the central use cases of our clients today. Now, just as a motivation, totally right that there's this debate between divestment and engagement, but there's also another insight that brings us to all of these different metrics. First of all, carbon footprinting doesn't really work as a portfolio construction tool. And the reason is because the majority of the investments in a portfolio usually comes from only three sectors: materials, energy, and utilities. And if you're looking at climate change from a risk or an impact perspective, I think it's fair to say that just making a shift on those three sectors doesn't really make sense. But it's also uneconomical because it really leads to very skewed portfolios that are completely unacceptable to most asset owners. Now, there are many climate metrics out there, and MSCI has done a lot of research on the correlation between them, and the correlation isn't as high as you would think. And that is because they serve very different purposes. So let me point out 4 different use cases and which metric is the most useful one for that use case. So now most asset owners, I think, would want a temperature outcome, which is the essential whole goal of climate change mitigation. It's limiting warming well below 2 degrees, or if possible, below 1.5 degrees. That is the center of the Paris Agreement. And the best way to measure that, from our point of view, is a metric called implied temperature rise.
Yeah.
MSCI isn't the only company that provides implied temperature rise metrics. There is a TCFD, Task Force on Climate-Related Financial Disclosures, one of the main bodies in our industry, that has put out 23 recommendations of how to build such a budget-based metric. So this metric compares companies' plans to decarbonize versus the remaining budget that they have against a benchmark. And that over or undershoot is converted using climate science into a temperature. That's how that works.
Yeah.
Now, if you want to not work on divestment or portfolio construction, but if you are an asset owner that is convinced that you best work, you're a responsible shareholder and you want to do shareholder engagement, then I think there are many other metrics, one of them including past performance of carbon intensity, and also including some of the qualitative metrics that our analysts are collecting are a good starting point. But another more quantitative metric is our target scorecard. And this target scorecard, what it does essentially is it compares all of the different very heterogeneous climate targets that companies have and unify them in a way so that you can easily assess the ambition and the coverage of that target. Now, if you want to build a risk management system, that would be another use case. Then we propose what you mentioned earlier, which is climate value at risk. And climate value at risk is constructed in a way that you choose a scenario, and we have over 20 scenarios in our system. Then we do a sort of a simulation of what could potentially happen to a company's valuation under that scenario. And we model transition risks, we model technology opportunities, and we model 8 different physical hazards, and then aggregate all of these different subcomponents into one climate value at risk. And what it essentially is it's a relative valuation number, something like minus 15%, or it could also be positive, plus 10%, or something like that. And that'll give you an insight into how sensitive the business model of a company is to the scenario that you chose. Now, I want to say 2 things. One, at the core of this model, there's also a credit risk model. So this enables you not only to look at valuation, but it enables you also to look at a default risk. And the second thing that I wanted to say is, as I mentioned earlier, this doesn't need to be negative, but this can also be used as a tool to, in your risk management system, if you want to call it, finding opportunities in the market. This can also be a tool to identify opportunities.
And I think another thing that's interesting from the tools you describe is from the user point of view. Despite the incredible complexity, and I know because I've tried to have a look and understand some of these things, and I'm not a scientist, but the incredible complexity under the hood is then translated into like a single metric, which like a temperature effect or this VAR number or something like that, which I think is really important for these things to become widely adopted.
Yes, but it does require tools for analysts, especially for portfolio managers, to drill down into the data, to understand where the numbers are coming from, what the main drivers are, to understand the capabilities and the limits of these models. And that's why we also have tools that allow you to do this drill down on a company and on a portfolio level. One of the major trends that we've also seen at COP27 when it comes to financial markets and climate change is the huge range of emerging standards in climate in general. And I think that will drive disclosure to a new level, and will create databases that companies, data providers like us, and investors will have to reorient towards. One of the other major developments that we see in our daily business is that the number of asset classes that we're able to cover is rapidly expanding. A great example of that is the total portfolio footprinting tool that we have just developed, which basically realizes the PCAF standard. That's the Partnership for Carbon Accounting of Financials. It's basically, sort of explaining how financial institutions should carbon footprint. And that standard covers 6 asset classes. We've expanded our tool to 8 asset classes. We're developing the same thing for implied temperature rise now. So the whole idea of moving far beyond equity and corporate fixed income is already reality today. And investors now have the opportunity to even get these metrics for their private assets.
So in terms of absolute numbers, do you have like a number of companies that are covered by your analysis, roughly?
So we cover over 10,000 companies for carbon footprinting, ITR, and climate value at risk. And in terms of carbon footprinting, we cover more than 3 million securities, including securitized products, sovereign bonds, and things like that.
And in terms of new developments, what can people expect in the next year or two?
So I think this expansion of asset classes is the biggest trend people can expect. I think there will be a lot more data, base data, available. I definitely think that the models will become more granular and more complex. So this is really a space to watch and learn.
What we've heard today is, again, going back to the positive story, this is kind of a win-win, really, because by getting these metrics and changing your strategy to comply with a net zero target, you're also getting information that gives you interesting alpha opportunities, interesting investment ideas, and strategies that will try to ride this positive wave and actually make good returns while trying to mobilize that huge amount of capital that Charlotte referred to at the outset, which has largely to come from the private sector and private investors. So thank you very much, Charlotte, Fredrik, and Oliver.
Thank you, Richard. Over these 2 decades that I've been working in climate change, I have seen that it's a constant story of underestimation on the negative, meaning we would have never thought that emissions would rise this quickly, that would be that hard to reduce emissions, and that temperature and other effects would come this quickly. But also on the positive side, for example, the deployment of solar panels, we would have never thought price parity for solar would come so quickly. So I think we're still in this underestimation space. So that's very important to remember. That's why it's very important to act now.
From my perspective, I think the important point is that there is no right and wrong. There are several ways of doing this in terms of aligning your portfolio to a net zero strategy. The important thing is that you have a path, a process, and a target of where you're going, and you know where you're starting from, and you know where you're going to. We are very much looking forward to working with our clients in helping them in that process.
I think I just want to reiterate really that we see the transition presents a tremendous opportunity. Climate change risk is investment risk. And I think that the transition and the risks that come with it cannot be ignored by investors. And there are some tremendous opportunities in terms of unlocking some of that capital that is needed to transform and transition entire economies.